think more and more, Ian, we're realizing that our value add strategies it's just about execution. Like, we're not splitting atoms here. It doesn't take a lot of brain power really to push rates and monitor and manage the expense side of things. I mean, certainly we have some expertise we bring to the table, but I think the simplicity of what we do is, I think, a big takeaway. And this Granite City storage model is what we kind of were able to hone there, because that was just the second facility that we acquired. So we're able to take what we learned there and really then apply it across the rest of our portfolio. But again, sometimes I feel a little silly when I'm talking to investors and telling about these great returns we're generating, but yet we're not really doing anything like super innovative, super crazy. And that's one of the things we love about this asset class is, when there's moms and pops running these facilities, they unintentionally, or maybe a little bit intentionally, leave a lot of money on a lot of meat on the bone.
Hey everybody, this is the Yield Coach Show, Season 1, Episode 27. I'm your host, Ian Brown. Every episode we bring you dynamic entrepreneurs, real estate investors, business leaders, and inspirational guests ready to open up, share their story, the good, the bad, the ugly, so you can gain lessons, advantages, and accelerate your own success. Quick announcement, we have opened our doors to outside investors, and we'll have offerings for accredited investors coming later this year. If you wish to be included in our list, please email me at ian@yield-coach.com. All right, but enough of that. I'm very excited about our guest today. We have Tom Dunkel joining us today. Tom has 25 plus years of real estate and investment experience. He has a concentration in self-storage facilities. He is the Chief Investment Officer at Belrose Storage Group, a real estate educator and distressed debt specialist, and he carries an MBA from the College of William and Mary. Thanks for coming on the show. Tell us a little bit about yourself and your background.
Sure. So I finally left corporate America 2006 with a bucket of cash, ready to take on the world. And of course, that was probably the worst time in history to start a real estate career, because the next few years I got my butt kicked when the credit markets crashed and the real estate market crashed. And so yet again, I had to live in a crash situation. So. But I was determined to do it. So I reinvented. It was around 2010 that I discovered distressed mortgage debt. So I started buying distressed mortgages with the last few bucks that I had left. Had some success there, and that's around about the time that I met my partner, Joe Downs. We've been partners since 2010. And when I first told him what I was up to, because he had just gotten crushed in the commercial real estate downturn. I was in the residential side. But we met and we were both trying to figure out what the next move was. And so I was telling him about distressed mortgage debt. He said, "You're effing crazy." I said, "Maybe I am. I tell you what, you're a smart guy. Why don't you go, do a little due diligence, and we'll meet back here at the bar in a couple of weeks, and you can tell me what you found." Because as luck would have it, we lived in the same neighborhood, and there was a bar like right down the block. So meet back up at the bar. A couple weeks later, he says, "Yeah, I think you might be onto something here." And so we literally sat down in a booth and flipped over a paper placemat and wrote out our business plan on the back of the placemat. So
over a beer.
Exactly. Yeah. So we've been at that business, going on 13 years, and that business has it's certainly had its own fits and starts, but overall has been very successful. And that's given us the capital to do other things within real estate. So we've had a hard money lending business. We had a title company for a period of time. We did some fix and flip residential properties. We've done some multifamily. But around about 2017, 2018, we started looking into self-storage. And the light bulb just really went off for us. We just really liked self-storage for a number of reasons we can get into later. But we decided, given how great we saw self-storage able to meet our investing goals, we decided to shut down the hard money lending business. We decided to get out of the title company, and et cetera, et cetera. So now we spend at least 95% of our time on self-storage. We've built a great team around us, and we're just really excited about how we're poised to take advantage of the self-storage market going forward.
Yeah, that's exciting. I like that you've been through through two cycles. So you got like the kind of the .com technology bubble, and then you've got, of course, the fall of 2008. And
well, and today's no picnic either.
Today's no picnic, and I feel like a lot of people in this in the syndication space, capital raising space, to have at least one cycle under your belt isn't super common. I mean, a lot of the people that are, nothing against boot camps and multifamily syndicators, and I mean, I do some multifamily, but a lot of them haven't had to weather. They don't have any like applied knowledge of what it was like to have, the underwriting of your loan changed at the same time that your rents were falling, at the same time that your deferred maintenance was hitting, at the same time that you were ballooning. So I was appraising commercial real estate straight through that downturn, and I was young. I was in my 20s, but I'm with grown men that are crying with me, and I'm just the field appraiser going out to inspect their hotel or golf course or apartment. We had to do everything as appraisers, and I'm like, it's funny because it's made me so cautious. I've done well in my investments, but I think it's largely because I just started with like so much pain and suffering, or just interviewing people that were doing so poorly. So I think for someone like you to have like worked through that, and now when you take on other people's money, you can explain, well, here's what I do when things go wrong. Here's how, here's why I have the perspective. Here's why I'm a problem solver. Here's how we're going to get through it. So, so I'm 40 and I'm just barely old enough to have had any meaningful real estate experience right before the turn. So I did get about a year of appraising proposed hotels on non-recourse, roughly 90% LTV hotel loans, where the developer's getting, the new Mercedes on the first construction draw. And even at that young age, I was like, there's no way this is, there's no way this is good. But let's jump back to you. And I like that you did the lending side and mortgage side, but, and it's funny, we do share one other thing too. I just stopped in, around January of this year. I ended my 7 years of title and escrow. I'm not saying I would never do it again, but I'm a Florida attorney, and that's kind of my core service as a Florida attorney. It was a lot of my friends are in real estate. It was something I could do. It kind of kept me in some of the deal flow, but I don't blame you for getting out of title and out of lending and into investing, because that's what I did 6 years ago and have not regretted it a bit. And we did, I think if we can talk about it if you want, but finding opportunities through the distressed debt markets. I don't know if it's kind of hard to find distressed debt at this moment, but obviously that could happen. That likely will happen again. Have you done anything? Have you pulled deals from distressed markets? Have you pulled deals from distressed debt?
We really haven't. We got into the notes business because we didn't want to own the bricks. So we in that business, we try whatever we can do to not take over a property. Now we do have some commercial loans, and we've been able to. We don't, we're not taking over businesses certainly, because again, we like the paper on that side of the world. So, but we have been able to do some pretty advantageous workouts and things like that. One thing to note though is in self-storage is the lowest defaulting asset class out there in commercial real estate. It's virtually zero. So I don't think we'll be seeing any self-storage deals coming up in the REO world, but that's not to say that self-storage is completely, pandemic and recession proof. It's certainly pandemic and recession resistant, and that the numbers prove that. But it's not the kind of asset class that defaults, which I think gives our investors a nice, warm and fuzzy feeling that at least they know that it's going to be, their investment's going to be pretty safe with us.
I think that's a good segue because, your company, just from what I see on your website, concentrates in storage. Let's jump into why you like that asset class. I can tell you that although I don't own any of it, I am drawn to it just because it is the polar opposite of trying to pull off a value add multifamily deal, and I'm in Jacksonville, and I had at one point, I think I had like 20 Section 8 tenants, which might not sound that high, but in a small portfolio, I'm juggling Section 8 and
Mm,
renovations, and I'm like, oh my God, I just want some storage.
that's
I want something with like no toilets. And I think I saw
right.
that on your website. But yeah, let's just talk a little bit about storage, self storage as an asset class, and I'll let you run.
Sure, yeah, yeah. That Section 8 world is brutal. I used to live in that. I probably one of the happiest days of my life was selling my last rental property. So that was great. I wonder if you know Brian Scrone down there in Jackson.
The name
He's
doesn't
a
sound familiar. I
okay.
was a naive, early 30-year-old. I was like, oh, I was
Gotcha.
the price per unit was good. It was a
Yeah.
third of replacement costs. I had Section 8 tenants. I had someone that I thought could manage it, and I just
Yeah.
went for it. But no, if
No,
he's good at
well,
what he does, I probably don't know him.
yeah, I feel the same way. I mean, there are some people who are really good in that world. I was not, and so when I found storage, it was like the sun rising and the angels singing and the unicorns flying around. Because you don't have the craziness with tenants. There's no plumbing and issues in all hours of the night. When you do end up in a landlord tenant situation, it's not that way at all in self storage. We actually work under lien laws, not landlord tenant laws. So our eviction process is quite simple. Day 61, the tenant gets a notification that their stuff is going to be auctioned off in 7 days. And if they show up and pay, great. If not, then we're able to auction it off. And that whole process is very automated. It's all driven, it's all on the internet. And so it's not like the Storage Wars show that people like to talk about. It's not like that at all. Um, but that's certainly one part of the world that's way better in self storage. The other one, you mentioned multifamily. I'm actually I've invested in multifamily deals as a limited partner multiple times since 2013. So I know a little bit about that world as well. And I do like that world. I've hooked up with a great operator there, and he generates some nice returns. But I do appreciate self storage because some of the challenges that he faces we don't face. For example, we were just talking about turning around a unit, right? We can have a unit cleaned out in the morning by a tenant, and then we can sweep it out and have it up for rent that afternoon. And a lot of times, because demand is pretty high for self storage these days, we can not only have it ready to be rented, but we can have it actually rented in that same day. So we don't go through an extended turnaround process where we're doing the paint, we're changing out the countertops with granite, throwing in a new lighting package, doing the carpeting. We don't have to go through those hoops, and therefore our capital expenditure budget is much lower, and our turnaround process is much faster, which creates a lot more cash flow. So that's certainly something we love. Another big thing that we love in self storage as compared to multifamily, and I don't want to beat up multifamily because I am a fan, but self storage, our operating profit is generally in the 60 to 70% range, whereas in multifamily, it's the other way around. It's more like a 30 to 40% range. I think is pretty widely accepted as the profit there. So again, it just makes self-storage a much higher cash flowing asset class as compared to multifamily. And that explains what we touched on earlier about why the default rate is so low, right? Because there's so much cash dropping to the bottom line. There's plenty of money left over there to service the debt and also pay a nice preferred dividend to our investors.
No, I think that's a great summary, and I appreciate that, and I totally agree. On that asset level discussion, I think there's a perception that storage is owned and controlled by the few, and but I think that's not actually true, right? I think you could probably tell us that there's quite a few quote unquote mom and pop operators. I was looking again. I was on your website before this interview, and I do see a lot of like single story, exterior corridor, more of your traditional sprawling product. and I imagine less of those are owned by REITs or regional institutions, and maybe you could, have a chance with cold call or outreach or networking. But if you could, what I'm really getting at is if you could kind of speak to maybe the myth that it's just a bunch of very large investment companies that control all these, and then kind of go into maybe how you're sourcing some of your deals.
Sure. No, you're spot on, Ian. You're right. The perception is that, CubeSmart, Public Storage, Extra Space, those big guys control the market. So there's no room for the little guy, but that couldn't be further from the truth. Those big real estate investment trusts only control about 30% of the market. There are some large regional players that you probably haven't heard of, but are still bigger players. But it leaves a good 50 to 60% of the market is still, onesie, twosie, mom and pop owners of that single story drive up product that you were just describing, and not the fancy, class A, 3, 4, 5 story facilities that, we frankly have little to no interest in those because there's typically not a lot of value add there. And those facilities are very expensive to run. So we do like the secondary and tertiary markets. And we do have a really, I have to say, pretty slick internal process for our lead generation. So we use virtual assistants to reach out to the lists that we buy of the self-storage owners. So our Philippine-based VAs are smiling and dialing and making hundreds of calls a day. If they get something that sounds like there might be a conversation to be had there, it gets kicked in to our U.S.-based VA, who is a retired sales guy, and he loves talking to people, and he can sense if there's a deal there or not. And if he's sensing that there's something warm there, he kicks it over to my business partner, Joe Downs, and Joe has the conversation with them, just trying to see if we can help them out with their facility in any way, or where are you in the life cycle of your ownership with this facility. And so at the end of the day, we're probably looking at over 50 facilities for each one that we acquire. So we're very disciplined and very strict about our acquisition criteria there, but we're generally looking very much like multifamily, right? We're looking for those markets that are growing, the population's growing, the jobs are growing, there's infrastructure investment going on there. So we look for all those things. And then, of course, we're looking to make sure there's not too much competition in that market as well. So, there's a lot of markets where it's just been way overbuilt with self-storage. But then there are other markets where, for whatever reason, there might be barriers to entry to developing self-storage. And so those areas might be undersupplied in storage. So we like to find that. But we do a lot of research in the market before we're even really looking at specific facilities.
And I can attest to Northeast Florida. We have IL, this light industrial IL zoning. You can do it in HI, and you can do it in a PUD, and then you can do it in CCG too. But my point with that is, especially the industrial zoning, it's hard to come by, and it's going away because if it's in a kind of a transitional area, it might go multifamily or it might go general commercial, and we're not rezoning much property in Jacksonville to that light industrial. I'm not saying we're not doing it at all, but to your point, we're getting about 30,000 people a year moving to Jacksonville, a lot of single and multifamily development. And you're gonna smile because you know this already, but these new communities, whether they're single, multi, towns, whatever, they don't allow you to park your boat, your RV, your oversized vehicle, your work truck. And I know this is more surface storage. It's actually a question that I have for you, but it just bodes so well for storage, because people that are in different phases of life still need the storage. It could be they actually lost their home or primary residence, and they still need to store some belongings. It could be a downsize. It could be you're retiring, you want to drive your RV for a year, and you want to it's almost endless, the reasons why you might need it. And as a culture, Americans don't like to let things go. We hang on to stuff, so we store it. But I completely agree with you that you see this kind of proliferation. I'm in Florida, so we have so much positive migration in home building. It is stalling a little bit right now, but really just over interest rates and construction prices. There's still lots of people coming here, even after the hurricane damage.
Yep.
But you just don't see like the pro rata or requisite storage being constructed. And if you do, it is your interior corridor, climate controlled, the things we're used to seeing coming out of the ground. It's on, like an acre and a half, 3, 4, 5 stories, that kind of stuff, which I know I'm rambling a little bit, but I do have a question. I think it would be, you're buying more of like your sprawling single story product that we've all seen kind of growing up. Why do you like that over the interior corridor towers? I do know those are expensive to build. I don't see people constructing new what you're building. I would imagine the price of land makes it hard to do that. But if you could just maybe opine a little bit on why you're buying the type of self-storage you're buying, and then where is the value add?
Sure. Yeah. Well, we do buy our primary buy box right now is buying existing facilities in secondary and tertiary markets where there is a lot of value add. And we touched on the moms and pops earlier. The moms and pops, their whole mission in life is to keep this facility full, right? And so they artificially keep their rents low, right? Because they want to keep those units full, and they let people go with delinquencies and that sort of thing. Because again, they're moms and pops. They're not professional self-storage operators. So the last thing they want to do is, implement the technology like we have, where you can rent a storage unit from your smartphone. They don't want to do any kind of marketing, any kind of outreach. They don't want to deal with the turnover of the units, even though it's quite simple in self-storage. They just want the units to stay full. So the facility that we just bought last week, for example, in upstate New York, classic situation. The owner is 83 years old. He's got a place down in Florida. He just wants to, play golf. He told us, he said he's happy with the amount of money that's coming in each month. So he doesn't want to rock the boat there. Right. So he's okay. And he knows his rates are low. And so he said, you guys go ahead and push the rates, and, you do what you're going to do. I'm happy with how I ran the facility. And he had his daughter there and was overpaying her as a manager, just all those classic things that moms and pops do. So that's one of the first things we look at, is we want to make sure that the rental rates that they're charging are well below market. So in this case, they were 34% below market. A lot of deals that we see are 20% below market, 25% below market. And again, it's because these moms and pops, they don't want to deal with it. They're happy with how things are running, and they don't want to rock the boat. So that's why we like those mom and pop, single story, what we call first generation self-storage facilities, as compared to the newer, multi-story facilities. Those are typically professionally run. That's most likely going to be one of the real estate investment trusts running that facility. And even though they're not super great at managing the facilities, they're really pretty good at it. So the value add there is kind of minimal. And for that kind of facility, there's a lot more upkeep. The elevators break, and there's just a lot more work that needs to go into keeping that facility up and running smoothly. So that's why and those facilities are typically more in the urban and suburban areas that are super high priced and don't really meet our acquisition and return criteria. So that's why we steer clear of those. As far as building and developing, it's again, back to the secondary and tertiary markets. The land out there is lower cost. And so we're able to build facilities out there. For example, in Lynchburg, Virginia right now, we're doing an expansion. And so we're building some ground up new buildings there. So we're able to do that relatively inexpensively as compared to those, multi-story. I mean, that's, you're really getting into big dollars there. And so it's a careful balance between that supply and demand and the costs and the returns. So what we found in our company is we prefer to buy the existing facilities that are mom and pop run, where there's the value add components and maybe there's some expansion But to date we've steered clear of the pure development. It's something we're going to look at later on after the supply chain issues kind of resolve themselves and after the financial markets kind of cool off a little bit. I think we're going to be looking at that as the next phase of development for Belrose Storage Group.
And I would imagine kind of like multifamily, the lending environment might be, you can correct me, a little more favorable if you're doing like your cube smarts and your interior corridor climate control stuff, and maybe a little better LTV, maybe a little bit lower rate, maybe some more non-recourse debt. But it seems like you're able to completely, that's almost irrelevant because the returns you're able to achieve by moving rents, like you just said, 30 something percent. It would be, you would never come across like a cube smart that, especially if I believe it's being run by algorithm or being checked almost every day, and they're changing their prices internally almost every day online. So the odds of you finding a professionally run franchised interior corridor project, there's just not going to be any meat on the bone, right?
Right, and you're right on. They do what's called dynamic pricing, right? So that unit up in the back corner on the 5th story is going to be priced lower than the unit that's right inside the door on the 1st floor.
What kind of I know it's a funny time to ask it. So we're recording right before Thanksgiving. This episode will probably air a little bit closer to Christmas. But look, as of now, maybe not so much rate per se, but what kind of LTV did your company enjoy in the lending environment since you got hot and heavy in storage? Sounds like maybe 5 years ago.
Yeah, so it's interesting, Ian. We had got a loan commitment for a deal that we're closing here right after Thanksgiving. It was from a local bank in Bowling Green, Kentucky, where our next acquisition is. 5.5%, 75% loan to value, and they said that they would be willing to go to 80% loan to value. 25-year amortization. And so really solid terms. We're pretty conservative. So we said, thanks for the 80%, but we'll stick at 75. But then 2 weeks later, we got some indications on our next deal, which is in Georgia. And that term sheet came in at like 7%, 65% loan to value, 15% or 15-year amortization. So all those factors just hammered our modeling and our return expectations. I mean, we're pretty conservative, and obviously, we've been around a little bit, so we knew that higher rates were coming and maybe a little squeeze on the LTVs and the term and whatnot. But that was pretty extreme. So we've since found better terms, but my point is that the world has shifted pretty quickly, and but it seems to be very lender specific, because I think there's still lenders out there that maybe are smaller. They know their particular market and they're comfortable lending there. And it also depends, not to get too much down the rabbit hole about banking and finance, but it also depends on where they're getting their capital, right? Because not everybody's rates have gone up. So these banks, the smaller ones, are typically still able to make a spread on what they're borrowing at and what they're lending at for their profit. But in general, we've had best execution on the lending side from smaller local banks and credit unions.
Do you like to use mortgage brokers, or do you tend to shop the debt yourself?
Yes, we actually have a two-prong approach there. We do use mortgage brokers because they have those pre-existing relationships and they can go out and grab some term sheets pretty quickly. But then we also do our own homework, and we reach out to some local lenders in the market where we're acquiring and see if they would be interested in financing our self-storage acquisition.
I have a note here that I jotted down before we started, and personally, I'm drawn to doing a surface storage deal. Really no improvements, just stabilize the soil, fencing, some security. Of course, I'm speaking like I've done it, but in Florida we have a lot of boats and RVs, and it's more or less a year-round boat and RV market here. And like we said, the new home construction and even a lot of the established neighborhoods, they don't want you to have those on your parcel. So do you have anything in your portfolio that is exclusively like oversized vehicles, boats, RVs, things like that? And how do they perform? What are your thoughts on that versus your roll-up door single-story product that I see as kind of a bread and butter for you?
Yeah, it's an area of interest of ours as well. We acquired a self-storage facility outside of Baltimore at the beginning of this year, and it was about 50% regular drive-up single-story storage, and the other 50% was boat and RV parking. And so we've gotten a little bit of a learning on the job training with that, and we do really like it. Our operating we're talking at the beginning about operating margins. Our operating margin at that facility is closer to 80% because it just doesn't take a lot of money to keep up a parking lot, basically. So that's an area that we are exploring. I think the one potential challenge there, and again, we're still kind of learning, but is on the lending side. I don't think the terms are quite as favorable on the lending side because your inventory is literally on wheels. So I think a lot of lenders are still kind of getting their heads around boat and RV storage. But it's definitely if you're looking at kind of the demographic trends and baby boomers like you were talking about earlier, driving their RV for a year and finally buying that boat and those kinds of things. It is an area that's caught our eye, and it seems like there's a huge demand for it. I had some preliminary stats that we learned about boat and RV storage where some RV folks will drive like an hour or more to get to their parking place because there's just none of them. There's not enough of them out there. And and the ones that are available they're really expensive, or you got to get on a waiting list, or it's a lot of barriers there.
I know in my Jacksonville market, so I don't have an RV. We do sometimes rent RVs and drive them as a family, but we have a boat and it's currently in dry storage, and I have no interest in owning a dry storage marina, but I did have it in a surface parking behind a public storage, like in the back. And it was so hard to find anywhere within 3 miles of my house that even had a spot for me. The access was this like quagmire weaving through, and it had the concrete columns. Mm-hmm. I'm trying to get my Silverado with the 20-foot boat weaving through and then back it in. Yeah. And then I finally get to the back of the facility, and I'm still under a tree, which is not where you want your boat to be. Right. So I'm still getting covered in leaves, and it's very hard to get to. And it was, now this is just my market, but it was over $100 a month just for the privilege of sticking it under somebody else's tree with bad access. And and it was actually, and I felt fortunate that I even found the spot. And so now to your point, demand is high. I'm glad you mentioned that the lending might not be as favorable if you don't have improvements. They might just view it as land. I remember I had a friend/client, they were looking to do, it was like 5 acres of mobile homes. All the mobile homes have been removed a few years ago. And then in my area, you can't really build another mobile home park right now in my area. The zoning doesn't really, it technically kind of allows it, but then you try to do it, you're not going to get your permit. It's kind of a glitch, but it's kind of falling out of favor in public opinion. So it was 5 acres, rectangular, ready to go, but it was more expensive than I would have thought to just finish clearing the lot, fence it, get some security, and like get the aggregate in there to make it stable. So I do think some people maybe underestimate the cost of a storage yard. Now, don't get me wrong, if you find a perfect square parking lot, well lit and fenced, then great. But if you're just looking at land, especially land with a little bit of topography to it and maybe some trees, it might cost you more than you think to get that land cleared and stabilized and fenced and lit and ready to go. We noticed that right away. And then when we went to a local bank, they did not like the fact that the business plan didn't have a building. Like they even said they would get, and it might have even been an SBA requirement, I can't remember, but if with no like vertical improvements, they weren't comfortable even doing a loan. Or they were going to view it like a land loan, which is going to be just absolutely horrible, 50% LTV or something horrible. So I did have a note here, Tom. in light of where we are in our economic cycle, I do think you happen to be like in one of the greatest asset classes, and I'm truly a little bit green with envy. I did well in multifamily before it was quite as, I mean, it's always been popular, but it wasn't quite as popular, 6 years ago. It's certainly not as has been in the past few years. And so I almost just got like elbowed out of my own, my own industry in a way. And, but I have always had an eye towards storage. And like I said, I used to do commercial appraisal, mostly in my mid to late 20s. And I felt like they didn't sell very often. People would buy them, they'd hunker down or maybe build a little owner's quarter, and that could sustain a family or a couple like their whole lives. And so I've wondered what it's like. Kind of, I guess I understand you have like the cold calling and the filtering and getting to you. It does, like if I thought about like could I get a few of these in my portfolio, I feel like it'd be a little hard to wrestle these away from owners because it's like a little golden goose. And like you said, even if they're 30%, 40% under market, they're full, they live on it. It's probably like fully depreciated, has almost no tax benefits anymore. But you tell me, a lot of these people take their money in cash and it doesn't really matter what their depreciation is because they're only going to claim so much. And then you got to go to the bank and try and finance a property that doesn't show all the income. That's a whole separate conversation. But it just seems really hard to wrestle these things away from established owners. Is that something that, would you concur that they're kind of hard to pull out into the market?
Yeah, I mean, it's definitely a little art, maybe more so than science. But yeah, you hit the nail on the head. A lot of the folks that our VAs get on the phone will say, "Well, I'll sell at the right price." I mean, you hear that all the time, right? But, we've had deals that have very long gestation periods, right? So like we'll start, the conversation, like the facility we just bought last week, we started talking to that guy, I think in January or February. And, it's just a kind of a long, get to know each other, get comfortable kind of process. And, then the negotiation takes a while because, he kind of works at his own speed and then, we got to do what we do. So, then we have our due diligence and all the things that we have to do to get comfortable acquiring the property. So, yeah, there's definitely some relationship building that goes on there. In fact, this facility in New York, the seller originally got an offer from U-Haul because the facility has a nice sized parking lot and the U-Haul wanted to come in, convert it to U-Haul and use that space to rent trucks. And, but he's, kind of an old school guy and he didn't want to do business with the big bad corporation. Right. So he liked, so Joe, my partner Joe, ended up speaking with him and he liked Joe. He liked our story that, we're smaller and entrepreneurial and, I don't know, maybe reminded him of his younger self or something. And so it just kind of came about that way. And that's not unusual. That we've had several deals that have had that same kind of dynamic where the seller just came to like us better and wanted to do business with us.
Mm-hmm. And I totally agree. It's funny that everyone thinks like, well, why would a seller let a property go for something less than top dollar? Well, there's a lot of reasons. You might just,
Mm-hmm.
Tom might be easier to do deals with than Ian or U-Haul, and it matters. I always try to be an easy buyer. I try not to throw a fit unless something's really, really a problem.
That's right.
Well, Tom, I want to pivot into what I call the coach's case study and do the Coach Brown kind of breakdown of a deal. Do you mind running us through a sample deal? It doesn't have to necessarily be typical, but run us through what a deal looks like. We have the categories of how'd you find it, how'd you fund it, how'd you fix it, how'd you exit unless you held, and was there a lesson or a takeaway? So I can help you with those those prompts again. But if you could talk us through one of your storage deals, I think it would be enlightening to have a little case study.
Yeah, for sure. We had an exit a little earlier this year that I think lines up with that case study outline you just gave really well. So we acquired Granite City Storage down in Mount Airy, North Carolina, in January of 2021. And we were excited about this acquisition because it was a mom and pop acquisition. But not only was this facility a mom and pop, but every facility in the market was a mom and pop. So they were all full, all the rates were low. And so in that situation, if we raise our rates on our customers, then they have a decision to make. They either, go through the hassle of, coming over to the facility, emptying out their unit, moving their stuff down the street, only to save $5-10 a month. So we were actually able to really be the leader in that market in terms of driving rates. So when we came in and we closed on that acquisition, we were really it was interesting. We raised our rates, and then of course the whole market sees what we're doing, and they start raising their rates. So I think we helped to raise the rates and frankly the property values across the entire market. So nobody paid us a commission for doing that, Ian, even though we made those guys a lot of money. Yeah. But I think it just was a great proof of our value add strategies, because as I mentioned earlier, we do spend a lot of time looking at the market. We do spend a lot of time looking at the competitors. Are they full? What are their rates? What are their rate trends? And so this facility lined up perfectly for that. It's 402 units, which is a decent sized self-storage facility. It was well located. It was in really good condition, and it was single story, like we've been talking about. So we went in there with our acquisitions team. You asked about funding.
Yeah, so I just to keep it organized here. So the find, did it go through your channels of the VA, the cold call filtering, all the way to, I believe, Joe?
That's correct.
Yeah, your partner. Okay.
Mm-hmm.
So it goes through your process, your funnel, your outreach.
That's right.
And now, how did you fund it?
So the funding was we went through a mortgage broker and lined us up with a credit union. Actually, I don't know if there's such thing as a national credit union, but the credit union's based in Minnesota or Wisconsin, and they're making a loan on a property in North Carolina. So we were able to get really good terms with them. I don't remember them quite off the top of my head, but I want to say that the rate was maybe in the threes, in the high threes back then. I want to say like maybe 3.95, somewhere around there. No prepayment penalty, which lined up nicely with our strategy of getting in, creating a lot of value in a short period of time and exiting. So that worked out great. And that was a recourse loan. So we were happy to sign on the dotted line there because we knew there was a lot of value to add there, like we've been talking about the whole show here. Mm-hmm. On the equity side, we do syndications. Now, as I mentioned, this facility closed in January of 2021. We went out to market to raise capital in December of 2020. And so before you knew it, we were right in the holiday season. Got a little nervous because, of course, people tend to shut down for that period of time. But I'm proud to say that we were able to raise over $1 million in the 2-week time period right around Christmas and New Year's, so that we could close on time in the beginning of January. So that was pretty cool.
Congratulations.
Yeah, thank you.
And not to cut you off, we'll get to that. But is my math right? You did this like a month before COVID, or narrowly before COVID.
That's right. Yeah, a couple months before COVID. That's right.
It might have been a tough capital raise there, like in February or March of that year.
That's true. Yeah. So
yeah, it's a good job.
So, yeah, we lucked out on that one.
And then as far as I call it the fix it. So we know how you found it. You said how you funded it. Mm-hmm. I'm sorry. What was the LTV on the credit union loan? Do you remember?
75.
Okay, so you got good LTV, good rate. Mm-hmm. And fix it could mean a variety of things. What did you do to add value?
Yeah, so we bought the facility for $3 million. At the time, the net operating income was about $200,000 a year. They were running a lot of expenses through there, and again, they weren't really pushing the rates. They were trying to sell things like boxes and tape and things like that, which we don't do that because it's more of a hassle than it's worth. It's low margin product, and it's just more of a headache, and it requires the manager to be on site. a lot of the time to handle those little transactions that don't make any money. So to us, it just doesn't make any sense. So what we did is as we've been talking about, we pushed the rates, but we also implemented our, I don't want to say patented, but it's our value add hybrid management structure. So we really leverage technology so that our facilities are running on technology. A customer can rent a unit right from their smartphone. And so that doesn't require someone on site physically as a manager, all day, every day. So that's a big waste of money. So we have this hybrid structure where we have an on-demand manager. They do act as the call center. So if a phone call comes in for the facility, they're picking up on their cell phone, but they can be anywhere on the planet pretty much and still handle that call and handle that customer's request. So we were able to do that, which helped us to really cut down on the expenses. So over that period of time between pushing rents, we did add tenant protection. So we can't call it insurance because it's not exactly insurance, but it's another revenue stream that we add at our facilities as part of our value add strategies. So customers are required to have buy this protection plan. And so that just bumps up the rent a little bit each month. But as as a multifamily guy, there's every little bit of bump up, you multiply that across 400 units and 12 months a year and throw a cap rate at it. Next thing you know, you're creating hundreds of thousands or maybe millions of dollars of value with just every little bump there. So we were able to do that. So in about 18 months, we were able to take that $200,000 net operating income facility and turn it into a $300,000 net operating income facility. And so that net operating income expansion and a little bit of help from cap rate compression allowed us to sell the facility for $4,795,000 18 months later, run that through our waterfall, and our investors enjoyed a 37% IRR on that project.
Wonderful. I'm gonna clap softly because I have a high gain microphone, but good job. No, that's wonderful.
Yeah, thanks.
So on that one, what I like about it, well, there's a lot of things that I like, but you didn't just, and nothing, I'm a Florida broker too, but it's like, you didn't just call a broker or what do you have? You worked at it. You found the deal. You teased it out. You said you look at 50 to every one you might buy. There's work involved. Mm-hmm. I hope the audience hears that. That's meaningful. And then what I like is that by finding it and like kind of taking your time and really getting the right deals, because I'm a guy, I would rather buy nothing than overpay. I have no interest in high volume. I just want to buy the right stuff.
Yep.
That's what you guys you're doing. I really like that. And then what I also like is your reposition, your value add plan. It's not particularly capital intensive. It's more, managerial value add, and that's really nice too, because you don't have to worry about like, okay, the bank's going to give me this, my limited partners give me that. Do I also have to raise all this rehab money? You don't really have to do. It doesn't sound like you have to do that dance as much. So, and you have an asset class. I'm falling in love with your asset class more than I already was, which is hard to imagine. But you're able to own in Georgia and New York and all. You've mentioned all kinds of states that are not contiguous on this interview, and it sounds like you're able to at least asset manage or like have, nearly property manage from all over the place. So that's unique. You can't do that in every asset class.
That's right.
What would you consider in that deal? My last thing is item 5 is like a takeaway, a lesson. Would you consider? It sounds like it's something you've already done a few times or many times, but what would be a lesson you might have identified from that deal?
Yeah, I think more and more, Ian, we're realizing that our value add strategies it's just about execution. Like, we're not splitting atoms here. It doesn't take a lot of brain power really to push rates and monitor and manage the expense side of things. Certainly we have some expertise we bring to the table, but I think the simplicity of what we do is, I think, a big takeaway. And this Granite City storage model is what we kind of were able to hone there, because that was just the second facility that we acquired. So we're able to take what we learned there and really then apply it across the rest of our portfolio. But again, it's sometimes I feel a little silly when I'm talking to investors and telling about these great returns we're generating, but yet we're not really doing anything like super innovative, super crazy. And that's one of the things we love about this asset class is that, when there's moms and pops running these facilities, they unintentionally, or maybe a little bit intentionally, leave a lot of money on a lot of meat on the bone for a company like Belrose Storage Group to come in and execute our value add strategies and create a lot of nice returns for our investors.
All right, I'm really liking this interview. All right, let's we're just going to run into what I call the Coach Brown breakdown. Just a few things here, and then we're going to send you on your way so you can get to your family. But
thank you.
What would be a impactful real estate business or personal development book that you would that you've read recently that you would recommend for the audience?
Sure, you can probably see it over my shoulder here. Is Who Not How. As entrepreneurs, we love to, kind of smash through walls and do things the hard way, trying to figure out, solving our own problems and just do, we're wired weird that way. But reading this book, Who Not How, was like such a revelation for me. Like, wow, you mean I can go find somebody who's an expert or really likes that area that I hate or I'm not good at, and they can, for a modest price, they can help me, get over this obstacle or, figure out this problem. So that's been huge for sure. And that was a recent book that our entire team has now read, and we're implementing that. And that's actually how we ended up bringing on. I've mentioned VAs multiple times in our interview today, and that's one of the things that came out of that is we were trying to do too much in-house, and it was stressing me out, stressing out my partners. And we're trying to do things better now, smarter, not harder. And so asking, when a question, problem, obstacle pops up, now the question is, who can help us figure this out? Not what do we have to do, or how do I need to fix this myself? It's who can I reach out to in my network? So that's been huge.
No, that's wonderful. And you're right. And I run a small shop too. And it's like a metaphorical fire emerges. And you're like, well, I guess I just have to belly flop on it. It's just me and put it out, No, it is. And I've read the book. It's a great one. I think it's got to be on my top 5. I love that one. I probably because it's really fresh in my mind is I really enjoyed Atomic Habits. I finished it like in the past 30 days, but that's another one. Thinking about it takes the burden off of you to have to solve all these problems. And then Atomic Habits kind of helps you realize these little incremental changes can make a big difference. And then you take that with the who not how notion, and it just makes the entrepreneurial journey a little more enjoyable. All right. Now, when you're not crushing these investment goals and snatching up mom and pop storage facilities, what do you do for fun?
Before we got on the air, I was admiring your Fender Stratocaster there behind you. I'm a guitar player myself. I've got a nice little guitar collection at home, so I enjoy doing that. And then my other passion is golf. I've been a golfer pretty much my whole life, and I've had a lot of fun with that. Even if I don't play well, I still enjoy being outdoors and enjoying the nice scenery and hanging out with my buddies.
That's awesome. I'm still waiting to break that elusive 100. If that tells you.
Well, you're in the right place down there. I just There's a lot of good golf around you.
Yeah, I end up playing these local real estate scramble tournaments, and there's kegs every other hole. It's just not the environment that I'm going to break 100. All right, now lastly, where can people find you? They want to get to know Tom, and they want to get to know your investment.
Sure, yeah. Appreciate it today, Ian. It's been a lot of fun. I'm Tom Dunkel. I'm the Chief Investment Officer of Belrose Storage Group. You can find us at belrosestoragegroup.com, BEL, just one L, BELROSE, storagegroup.com. And on our website, I'd invite you to sign up for our investor portal, because when you sign up as an investor, you'll get notifications of our upcoming self-storage syndications. And we also have an ebook there that I think could be valuable for folks who are looking to get involved in self-storage or multifamily or other kinds of alternative asset classes. I know if you're a busy 9-to-5er and maybe you're not sure how to look at or analyze an alternative deal. This ebook gives you a framework to do that due diligence so that you can get out of the stock market, roller coaster casino, and come on over to the nice, cool waters of multifamily and self-storage and other alternative investments. So look for that ebook there. It's called The Safe Method.
Amen. Yeah, get out of that. Actually, I was looking right for now. This interview again might come out in a few weeks, but I think the S&P was down year over year, 15 points on the percent as of today, and you just gave your investors a 37% IRR. So, yes, exactly. I could go on and on about that, but anyways, I'll leave that alone. Okay, well, this has been a lot of fun, Tom. I really appreciate your time. The audience, you're our first self-storage guy, and you really did a great job talking us through the asset class, and your company's doing great.
Thank you. It's been great, Ian.
All right, everybody. Yeah, I really did enjoy it. All right, everybody. This is the Yield Coach Show wrapping up. I'm your coach, Ian Brown, signing off and reminding everybody to lace up and leave it all on the field. Yield Coach out.